Hello and welcome to the AUSTRAC Reporting Entity Forum. My name's Michelle and joining me today are Srabona and Gemma. We're from the Industry Education and Outreach team here at AUSTRAC. Firstly, AUSTRAC acknowledges the traditional custodians of country throughout Australia and their continuing connection to land, sea and community. I pay my respects to the elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples joining us today. And thank you all for taking the time to join us. The purpose of this forum is to help you improve your AML-CTF compliance by providing you with sector-specific insights, address some common challenges, and offer practical guidance. So before we begin, we do have a couple of housekeeping items to address. Now, while this webinar is designed to highlight key regulatory insights that may be relevant to your business, it does not constitute legal advice. And should you need to do so, we encourage you to obtain your own independent professional advice specific to the unique needs of your business. This webinar should not replace or form part of your AML-CTF risk awareness staff training program. And finally, we will be providing a brief update on the upcoming reforms, but please keep in mind that this is not the focus of this webinar. The AML-CTF rules and associated guidance are still in development, and AUSTRAC will provide education on this as details become available. In today's session, we'll explore several topics, including a brief update on the upcoming AML-CTF reforms, AUSTRAC's regulatory priorities, insights from the regulatory supervision team, including common compliance challenges observed across the sector and their future focus for supervision work. We'll share insights into AUSTRAC's enforcement activity and on how we respond to non-compliance. And finally, we'll take a look at the 2024 compliance report data and how this may shape AUSTRAC's priorities. Before I hand over to Srabona, I'd like you to take a moment to think about why you're here and what you'd like to take away from this session. I encourage you that while you're listening to each speaker, have a think about whether your business is meeting AUSTRAC's expectations in these areas. And if you are there other areas where you can still improve? And if your business isn't meeting AUSTRAC's expectations, what will you do when you go back to your business to improve your AML-CTF processes? Now, to kick off today's session, we'll start with a brief update on those AML-CTF reforms, what it means for you and what's coming next. And I'll hand you over to Srabona.
Thank you, Michelle. As I'm sure you're all aware, Australia's anti-money laundering and counter-terrorism financing, otherwise known as AML-CTF, regime is undergoing reforms. These reforms are indicative of the Australian government's commitment to protecting the integrity of the Australian financial system and improving the AML-CTF regime. To this end, the AML-CTF Amendment Bill was passed in November 2024, amending the Act and progressing the simplification and modernisation of the AML-CTF Act, rules and regulations. One key objective of the reforms is to expand regulation to Tranche 2 entities. These include lawyers, accountants, trust and company service providers, dealers in precious metals and stones, and real estate professionals. Services provided by these sectors are recognised globally as high risk for exploitation, but are not captured under the current AML-CTF regime. For existing reporting entities such as yourselves, the reforms also aim to increase flexibility, reduce regulatory burden, and improve clarity by making key terms, obligations, and terminology more consistent across the AML-CTF Act and the rules. This simplified framework is designed to help you better understand your obligations and strengthen your ability to detect and prevent financial crime. The reforms also aim to modernise the regime so it remains fit for purpose in a rapidly changing financial environment. The reforms expand the risk-based approach, allowing flexibility as businesses continue to evolve. And as part of this process, AML-CTF program requirements are also set to change, moving away from tick box compliance. The reforms will also better define the roles and responsibilities of a reporting entity's governing body and AML-CTF compliance officer, further supporting stronger oversight and suitability. The Financial Action Task Force, known as the FATF, is the global money laundering, terrorism, and proliferation financing watchdog. Influenced by the FATF, global AML-CTF regulation is inherently risk-based. Their first recommendation is to identify, assess, and understand risk. And almost all AML-CTF obligations flow from this. As mentioned earlier, the updated requirements will place a much stronger emphasis on the need for meaningful, risk-based controls. One of the key changes is the introduction of proliferation financing. This is when a person makes an asset available, provides a financial service, or conducts a financial transaction that's intended to facilitate the proliferation of weapons of mass destruction, regardless of whether the activity occurs or is attempted. While some of you may have already been considering your proliferation financing risks, the reforms now expressly require this. It will now also be expressly required that reporting entities assess their money laundering, terrorism financing, and proliferation financing risks as part of their AML-CTF program. And while you may already be doing this in practice, this change formalizes that expectation and reinforces that your risk assessment must be the foundation of your AML-CTF compliance program. There are other structural changes to the AML-CTF program under the reforms, such as moving away from having a Part B and a Part A program, and a requirement for you to create and maintain appropriate AML-CTF policies to manage and mitigate the specific risks identified in your business. Beyond the content and structure of your AML-CTF program, the reforms also address practical elements, such as strengthening governance frameworks. The reforms will require you to have a governing body, senior management, and AML-CTF compliance officer, and the legislation will clearly define these roles. The governing body and senior management will be required to provide ongoing, effective oversight of the business's AML-CTF compliance and risk management activities. And while the obligation to have an AML-CTF compliance officer is not new, the reforms place a stronger emphasis on the suitability of individuals in these roles. This will mean compliance officers must meet specific fit and proper person requirements to ensure they have the necessary expertise, integrity, and seniority to fulfill their responsibilities effectively. More information on the AML-CTF compliance officer will be determined through the ongoing consultation on the rules. You may have also seen in the amendment bill that independent reviews, which will be known as evaluations, will be required to be conducted at least every 3 years. This does not mean 3 years will be appropriate for all businesses. The frequency with which evaluations must be conducted must still be appropriate to the nature, size, and complexity of the business. The rules will also clarify the requirements around the conduct of independent evaluations. Finally, a core objective of the reforms is ensuring obligations are clear and reflect contemporary businesses. This is particularly evident in a number of targeted changes, covering obligations like customer due diligence, international value transfer service reports, value transfer chains, and tipping off. So to summarize the targeted changes, you will have seen this clarity achieved in the reforms to the tipping off offence, which came into effect on 31st March this year. The changes now focus on whether disclosing information would or could reasonably be expected to prejudice an investigation. This new harm prevention approach shifts the focus from compliance to risk and reduces unintended compliance challenges or regulatory burden. There will also be changes to customer due diligence requirements to ensure a more targeted and flexible approach, focusing on outcomes that help mitigate risks associated with higher risk customers and transactions. The reforms clarify and simplify customer due diligence obligations, reinforcing that customer due diligence is an ongoing process. These changes will also clarify the level of checks applied to each customer initially and on an ongoing basis. They outline expectations around customers' risk rating, initial customer due diligence, ongoing customer due diligence, and enhanced customer due diligence. International Value Transfer Service reports will replace the current International Funds Transfer Instruction reports, otherwise known as IFTIs. The reporting obligation will now lie with the reporting entity closest to the Australian customer, better reflecting how businesses function. And these changes will all come into effect 31st March 2026. That brings us to the end of the reforms update. As mentioned, we will continue to provide more detailed guidance and education in the lead up to implementation. But let's turn our focus now over to AUSTRAC's current regulatory priorities and how they shape our engagement with industry. And I'll hand you over to Michelle for this.
Thanks, Rabona. The reforms provide insight into the future of the regime. However, our current work is guided by the risks and issues we observe across the reporting entity population. These priorities shape how we engage with industry, determine where we focus our supervision efforts, and how we support reporting entities to strengthen their compliance. In 2023, AUSTRAC published regulatory priorities for the first time. They outlined areas of focus to strengthen Australia's financial system and increase resilience to money laundering, terrorism financing, and other serious crime. AUSTRAC's regulatory priorities include, firstly, our enduring priorities, which are core areas of compliance, such as AML/CTF programs, risk assessments, reporting obligations, and high-risk sectors. The second is an increased regulatory focus on emerging and high-growth sectors. Now, this applies to digital currency exchange or virtual asset service providers, payment platforms, bullion dealers, and non-bank lenders and financiers. These sectors have been prioritised due to rapid and significant growth, due to concerns about their AML/CTF compliance and variation in compliance levels between entities within these sectors. And intelligence-led concerns have been identified by AUSTRAC and our partner agencies. The third priority is serious and systemic deficiencies. This relates to compliance failures in key areas, including board and executive accountability, transaction monitoring programs, and the outsourcing of AML/CTF functions. We understand that many businesses choose to outsource certain AML/CTF functions, perhaps to gain specialist expertise or manage costs. In September 2024, AUSTRAC released guidance on outsourcing AML/CTF functions to help reduce risks that can arise from outsourcing arrangements. The fourth priority is continuous improvement, which will modernise and improve Australia's AML/CTF regime. The Australian Government has reiterated its commitment to this through the legislative reforms that are taking place. And the final priority is partnerships, building strong relationships with a wide range of partners across industry, government, and law enforcement to support our regulatory objectives. These regulatory priorities aren't just high-level goals. They directly influence the way AUSTRAC approaches supervision. They help shape our engagement with industry, inform where we focus our attention, and guide how we assess and respond to compliance behaviours. To provide more insight into how these priorities have been implemented, I'll hand you over now to Gemma, who will share some of the regulatory team's recent supervisory work, key observations, and areas of focus going forward.
Thanks, Michelle, and hello, everyone. The Bullion Supervision Team has been newly created specifically to focus on the sector in response to AUSTRAC identifying the bullion sector as a regulatory priority. The team's activities with the bullion sector have only recently commenced, and all our current matters remain ongoing. Therefore, the insights that we will share with you today have very much been guided by AUSTRAC's activities with the broader reporting entity population. The themes I will share with you today are highly relevant to the bullion sector. As I share this information with you, I encourage you to consider your processes and what actions you can take to ensure you are meeting your obligations. The first key area for improvement is money laundering and terrorism financing, or MLTF risk assessments. AUSTRAC has observed during regulatory activities with our reporting entities from various sectors that uplift is required for MLTF risk assessments. In particular, AUSTRAC is concerned with risk assessments not being tailored to the business, risk assessments not being underpinned by qualitative and quantitative data. For instance, we are seeing risk assessments that are not backed up by data or evidence, and risk assessments failing to consider known MLTF typologies. To meet AUSTRAC's expectations, you must undertake an MLTF risk assessment, and it must be tailored to your business. No two businesses are the same, and this also applies to the risks your business faces. Bullion dealers are exposed to MLTF risk through a number of factors. Such factors include a high exposure to cash transactions. This is the case of many bullion dealers operating cash-intensive business models. The ability to use bullion to store and move funds. Bullion is easy to move domestically and abroad, and the variety of delivery channels used by bullion dealers, for example, face-to-face, online, and phone sales, as well as third-party arrangements. Identifying and assessing the level of MLTF risk to your business is an important part of your AML-CTF program. It is the first thing you must do because it decides what measures you need to include in your program. Assessing the MLTF risk your business faces enables you to develop an AML-CTF program with appropriate measures to protect your business from being exploited by criminals. You must measure the level of risk for every designated service you provide. You should rank each service as low, medium, or high risk. Once you have identified those risks, you need to put in place controls to manage and mitigate these risks. You must also be able to demonstrate how you determined your risk ratings and how the processes you have put in place will manage and mitigate these risks. AUSTRAC expects that you keep up to date with published MLTF typologies and trends. For example, you should consider how the current instability in global markets could potentially make bullion a more attractive asset class to criminals. You can find indicators of suspicious activity for the bullion sector and other guidance material on our website. The second area for improvement I'll share with you today is AML-CTF programs. AUSTRAC has observed that some reporting entities, again across various sectors, do not have an AML-CTF program, even though they provide a designated service and by law are required to. You will also have come across instances where if there is an AML-CTF program, it isn't tailored specifically to the reporting entity or doesn't clearly outline the MLTF systems and controls entities have in place. If you are a reporting entity, you must have an AML-CTF program. Your AML-CTF program must be a written document that shows how you will address the MLTF risks your business may reasonably face. You must develop and document the policies, procedures, and controls you use to identify, manage, and mitigate these risks. There is no one-size-fits-all AML-CTF program. Each reporting entity is different and has its own unique set of money laundering and terrorism financing risks. You must develop a program that is tailored to meet your specific needs, risks, and characteristics. This gives you the flexibility to decide how to meet your obligations and to develop stronger and/or additional controls when necessary. There are resources available on our website to help you understand your obligations and develop your AML-CTF program, and I encourage you to review these. The next area for improvement relates to customer risk. AUSTRAC has observed that an overall uplift in this area is needed, particularly regarding failures in entities identifying high-risk customers. In your sector, only 18% of reporting entities reported that they had high-risk customers in the 2024 compliance report. This indicates to AUSTRAC that there may be deficiencies in some entities' understanding of risk. Your customer identification procedures, also known as Know Your Customer, or KYC, are critical to ensure you know who you are dealing with and are satisfied that a customer is who they claim to be. This is crucial to guard your business against being exploited by criminals. These procedures must be set out in your AML-CTF program and outline how you will identify and verify your customers, depending on whether they pose a low, medium, or high risk. For example, if you identify a customer as being high risk, you will need to take additional KYC steps to ensure you are effectively managing your MLTF risk. This might include asking about a customer's source of wealth and taking reasonable measures to verify this, or clarifying the purpose of the customer using your business and services. Failure to correctly conduct KYC procedures on customers can significantly impact ongoing identification, mitigation, and management of MLTF risks and introduce risks across all aspects of your AML-CTF compliance. The next key area for improvement relates to reporting obligations. Reporting remains an area requiring uplift in the bullion sector. Currently, the number of suspicious matter reports, or SMRs, being reported is low, and of the ones that are reported, many are of low quality. This indicates to AUSTRAC that there may be a low understanding of indicators of suspicious activity in the sector, and also reporting obligations more generally. AUSTRAC publishes indicators of suspicious activity and other risk guidance to support you to understand the risks your business may face. It is critical that you engage with your risks and keep up to date with these publications so that you can ensure your risk assessment and your AML-CTF systems and controls are effective in detecting suspicious activity. For example, in the bullion sector, some potential indicators of suspicious activity may include when a customer buys or sells bullion frequently at a loss, purchases bullion in multiple transactions to avoid the $5,000 customer identification threshold or the $10,000 transaction reporting threshold, has an account that is paid into by a third party, inquiries about transaction limits or request their transaction not be reported, or is uninterested in the details of the purchase, such as price, transaction fees, delivery costs, or storage fees. Using indicators such as these in your risk assessment will determine what transactions you monitor and how and when you do this. Remember, when you look into these transactions, consider all the information and circumstances available. If a reasonable person would conclude there is reasonable grounds for suspicion, an SMR must be submitted to AUSTRAC. There are many resources relating to SMRs on the AUSTRAC website, including checklists, reporting guides, and video animations, and I encourage you to familiarize yourselves with these resources. The next area for improvement our team has identified relates to transaction monitoring. AUSTRAC has observed instances where entities' transaction monitoring programs, or TMPs, were not linked to an MLTF risk assessment. As I mentioned before, undertaking an MLTF risk assessment is the first thing you should do. AUSTRAC has also observed instances where TMPs have failed to identify key MLTF risks. In the 2024 compliance report, your sector reported that only 39% of TMPs detected suspicious matters in that last year. This indicates to AUSTRAC that transaction monitoring rules may require review and updating to ensure they are working effectively. Also in the 2024 compliance report, your sector reported 75% of TMPs were manual. Depending on the type, size, and complexity of your business, your TMP can be manual or automated. Regardless of whether you use a manual or automated system, you must ensure that you allocate appropriate resources and give priority to analyzing and actioning alerts raised by your transaction monitoring. Further information on transaction monitoring is on our website. Finally, I would like to take a moment to speak to you about independent reviews. AUSTRAC's 2024 compliance report data for the bullion sector indicates that only 55% of AML-CTF programs have been independently reviewed. This is a concern, as it means AML-CTF programs are not being tested to ensure their effectiveness. The purpose of an independent review is for an impartial assessment of whether your AML-CTF program is compliant and effective in adequately addressing your risks. You must ensure that your AML-CTF program is subject to regular independent reviews. Regular reviews assist with ensuring that AML-CTF programs are aligned with current risks and regulatory standards, providing a vital feedback loop for continuous improvement. In order to meet AUSTRAC's expectations, you must ensure your independent reviewer possesses the required expertise and maintains true independence. This ensures they can provide an objective and critical assessment. When selecting an independent reviewer, ask yourself, are they someone who understands your business or organization, understands your business's MLTF risks, and is not involved in any part of developing the program, including assessing your MLTF risk, developing controls, or implementing or maintaining the program. The AUSTRAC website has more information on independent reviews, including who can conduct one, examples of circumstances that quantify frequent reviews, and other explanatory notes. We hope that by sharing these key insights with you today, we have helped you to better understand your obligations and what you need to do to meet AUSTRAC's expectations. Before I pass back to Michelle, I will share the Bullion team's future focus. Looking ahead, we will focus on ensuring reporting entities across all sectors maintain risk-based and fit-for-purpose AML-CTF programs, monitoring how businesses are adapting their programs to respond to change in their products, services, customer base, or risk environment, supporting improvements in the quality and the relevance of MLTF risk assessments, assessing the effectiveness of transaction monitoring programs and the ability of entities to detect and respond to unusual or suspicious activity, and reviewing how entities apply enhanced customer due diligence measures and manage higher risk relationships and transactions. We will also maintain a strong focus on entities' governance and oversight arrangements, particularly the role of boards, senior management, and AML-CTF compliance officers, in ensuring programs are properly maintained and adapted to emerging risks. AUSTRAC's approach remains risk-based, intelligence-led, and outcomes-focused. We encourage all reporting entities to take a proactive approach to compliance, review your systems and controls regularly, and ensure they are fit for purpose in a rapidly evolving risk environment. By maintaining strong AML-CTF programs and engaging openly with AUSTRAC, you contribute directly to safeguarding Australia's financial system and protecting the broader community. Thank you. I'll now hand you back over to Michelle.
Thanks, Gemma, for your overview of AUSTRAC's recent supervision work and those practical insights that you shared with us. Supervision plays a key role in helping reporting entities strengthen their compliance, though there are times when more serious or systemic non-compliance issues arise that require a stronger response. With that in mind, we'll now provide an update on AUSTRAC's enforcement activities, including key themes seen in non-compliance matters and what the focus of our future work will be. If reporting entities do not meet their obligations under AML/CTF law, AUSTRAC can take steps to compel their compliance and/or seek a penalty. Enforcement actions are specific legal actions we can take to make sure reporting entities comply with the law. The enforcement actions that are available to AUSTRAC are civil penalty orders, enforceable undertakings, infringement notices, remedial directions, and another type of AUSTRAC action is we can take or issue, a written notice requiring a reporting entity to either appoint an external auditor to review your MLTF risk management and or AML/CTF compliance, or we can compel you to undertake an MLTF risk assessment. We can also refuse, cancel, or suspend the registration of remittance service providers and digital currency exchange providers if they pose an unacceptable risk of money laundering, terrorism financing, or other serious crime. Over the past year, AUSTRAC has continued to use its full range of regulatory tools, including enforcement powers, where necessary to respond to non-compliance and uphold public confidence in Australia's financial system. While we like to be transparent about our enforcement outcomes, it's important to note that not all investigations have progressed to the point of public outcome. So today I'll only speak to matters that are already in the public domain. We recognise that threats are evolving and controls won't always catch everything, but compliance failures in the AML/CTF regime can contribute to significant real-world harm. Where harm has occurred or where the risk of harm has been materially increased by the failures, reporting entities should expect AUSTRAC to act accordingly. Recently, AUSTRAC undertook significant enforcement action against several entities for failing to comply with their obligations under the AML/CTF Act. One of the more prominent matters involved a casino operator, where enforcement action led to a substantial civil penalty. The casino operator was found to have failed to meet customer due diligence requirements and had systemic weaknesses in its risk management and controls. As a result, the Federal Court ordered the casino operator to pay a substantial penalty. The decision was based on findings of serious breaches of the AML/CTF Act, particularly around ongoing customer due diligence and systemic control failures. These weaknesses allowed high-risk customers to move large sums of money through the casino operator's operations over several years, obscuring the origin and ownership of these funds. The casino operator also provided services through high-risk channels and to high-risk customers without implementing necessary risk-based controls. As a result, they failed to conduct the required checks on a significant number of customers, including individuals who are known to law enforcement or presenting indicators of potential money laundering risk. This outcome highlights the importance of establishing and maintaining a robust, risk-based AML/CTF program, not just to avoid substantial penalties, but to protect the integrity of your operations and reputation over the long term. Now, looking ahead, serious and systemic non-compliance particularly regarding foundational obligations such as risk-based customer due diligence, will remain a focus for AUSTRAC's enforcement work. In an environment of evolving threats, we recognise that some degree of failure is inevitable. Controls won't always hold up, and we accept that, but we are still seeing in too many cases basic obligations not being carried out effectively or at all, and unpersuasive proof that the business is taking reasonable steps to reach compliance. It's important to remember that AML-CTF is not a set and forget regime. You need to ask, how does MLTF risk actually play out in your business? And where are the real vulnerabilities? And how are you monitoring whether your controls are working and what happens if they're not working? The AML-CTF regime is not designed to eliminate all financial crime. It's about taking reasonable, evidence-based measures to identify, manage, and mitigate risk. That means you need to explore a tailored and proactive approach. There's no one-size-fits-all solution. Now, while we recognise that occasional failures may occur, it is critical that when these issues are identified, they're addressed promptly. Open, proactive communication with AUSTRAC, particularly where significant compliance concerns arise, is the most effective way to mitigate broader consequences. We saw this approach in practice recently when AUSTRAC accepted an enforceable undertaking from a corporate bookmaker following an extensive supervision assessment. The corporate bookmakers demonstrated willingness to cooperate and proactively address its obligations. Therefore, AUSTRAC determined accepting an enforceable undertaking from the corporate bookmaker was the most appropriate regulatory response. This matter highlights the importance of collaboration, transparency, and early action in supporting compliance outcomes. In contrast, a culture which encourages avoidance or compliance window dressing will also be a focus of AUSTRAC's enforcement work. By proactively engaging with AUSTRAC and strengthening your compliance frameworks, you directly contribute to safeguarding Australia's financial environment. So that brings us to the end of the enforcement update. And with that, I'll hand back to Sravona to continue with today's session.
Thanks, Michelle, for that update. It's a strong reminder that while AUSTRAC understands the challenges of managing financial crime risk, there's a clear expectation that reporting entities are actively identifying, addressing, and learning from gaps in their programs. For our final round of insights today, I'd like to take the opportunity to give you a brief overview of our initial insights from the 2024 compliance report data. Most reporting entities are required to submit a compliance report to AUSTRAC each year, answering questions about how AML-CTF obligations were met in the previous year. The information gathered from compliance reports provides key data for our risk modelling of reporting entities and industry sectors. It helps us understand how you are complying with your obligations, which areas are working well, and where gaps still remain. It helps inform how we determine our regulatory priorities, how we tailor our future engagement and our support. The 2024 compliance report closed recently on 31st March, so we're still deep in the analysis. However, a few early trends have already emerged, which align closely with the themes we've discussed today. I'll start with a positive outcome from the 2024 compliance report period, which shows 84% of reporting entities who have the obligation to complete a compliance report having completed their 2024 compliance report. This is up from 82% last year, so it's really encouraging to see an increase in engagement across the population. The data you provide gives us vital insights into how the regime works. It helps us shape guidance, identify gaps, and tailor our support. Ultimately, when we receive complete and accurate data, we're better placed to provide guidance and resources to help you meet your obligations and protect your business from risks. Moving on to risk assessment insights from the 2024 compliance report. It's encouraging to see that 70% of the bullion sector reviewed or updated their MLTF risk assessment in 2024. However, only 23% of bullion entities indicated they did so in response to AUSTRAC engagement, guidance, or feedback. We acknowledge that not every AUSTRAC engagement will require a full reassessment of your risk profile, but this number suggests that many entities are not adapting their programs in response to regulatory or environmental changes. For example, AUSTRAC published national risk assessments on money laundering and terrorism financing this past year. These risk assessments are a tool entities can use to review and update their own risk assessments. Last year, AUSTRAC presented sector-specific webinars, including to the bullion sector, to communicate the findings of these risk assessments. If you missed them, you can find the recordings of these webinars on the AUSTRAC YouTube channel. ECDD is required in a range of high-risk scenarios. However, we continue to see evidence of inconsistent application of ECDD controls, particularly around senior management oversight. 75% of the bullion sector reported they conducted ECDD in 2024, but only 30% of these entities sought senior management approval to provide a designated service, and only 39% sought senior management approval to continue with a high-risk customer relationship. These figures suggest that escalation protocols may not be working effectively, or that decision-making is not in line with entities' obligations. Compliance report responses continue to show variation in how these obligations are being met, particularly with the systems and controls that support detection and escalation of high-risk scenarios. And this has a flow-on effect to the governance and oversight of your obligations. For example, 23% of the bullion sector confirmed they outsource one or more of their AML-CTF obligations. And out of that amount, none of the bullion dealers said they provide any reporting to their board or senior management on the performance of their outsourced functions. Given that outsourcing is relatively common, this highlights the need for stronger governance around outsourced arrangements to ensure oversight and accountability remains in-house. Finally, let's talk about transaction monitoring. The data shows currently that 50% of reporting entities identified suspicious activity via their staff, while 37% identified it through their transaction monitoring program. This alone tells us there's room to improve TMP effectiveness. It's particularly important to highlight that entities that reviewed their TMP in the past year were more than twice as likely to detect suspicious activity. So 48% of entities who had reviewed their TMP detected suspicious activity, compared to just 22% of those who had not. And this reinforces a critical point. Much like your AML-CTF program as a whole, your transaction monitoring program is also not set and forget. Ongoing tuning, testing, and adaptation are essential to ensuring TMPs remain aligned with your risk profile and capable of detecting suspicious activity in real time. Altogether, these insights help us see where improvement is happening and where there's still work to do. And the data reflects many of the themes we spoke about earlier: the need for tailored risk assessments, consistent application of customer due diligence, clear governance, and effective systems and controls. We'll continue to use the data received to inform our regulatory focus and support activities, and we encourage you to reflect on how these insights might apply to your own program and practices. And that brings us to the end of today's forum. Thank you all once again for joining us today, and we very much hope you found this session valuable.